and flow chart. So when it comes to valuing an asset, selecting the right approach is very crucial. But which one should you use? Let's break it down. On one side we have the market approach, as you can see it here. So look at the market approach, look at the recent transaction and recent asset prices. This method compares similar asset considering their size, quality and quantity and some key characteristics, right? So it compare recent transaction, asset price considering size, quantity, quality and some key characteristics. That is called market approach. Second approach we have is called the cost approach. So cost approach focus on the fair market value of the asset minus liability, right? So fair market value of asset minus liability is what cost approach looks at. It is ideal for asset intensive business. So those business which are huge asset intensive, right, holding corporation or when dealing with troubled entity, then cost approach is most useful because it focus on the fair market value, does not focus on the recent asset price or recent transaction, right? And in the market approach I told you the comparison method work best, where we compare similar asset considering their size. And the third approach we have is called the income approach. So income approach is thinks about the future. This approach values asset based on the future earning or future cash flow. It's all about calculating NOI, net operating income, and dividing it by the capitalization rate. So you must remember the formula which formula we use to while using the income approach. So net operating income, NOI, divided by capitalization rate. So it values asset based on future earning or future cash flow. So the three method which we have just learned now, each method has its unique role depending on the type of asset. Like suppose the type of asset is asset intensive business, so we will go for cost approach. And suppose we are futuristic looking, then we will go for income approach, right? So each method has a unique role depending on the type of asset and business situation. So that is the point. So one should choose wisely to unlock the true value. Which one to choose? I hope I have given you sufficient insight. Now friends, let's have a look. So when it comes to valuation, choosing the correct method is not just important, it is crucial. So what are some valuation method selection criteria? So before we choose, we consider the basis of value, right? The pros and cons of each and every methods, that is called advantage and disadvantage, their appropriateness for the situation, how much they are appropriate for the situation, and the reliability of the information available, means whether the information available is trustworthy enough, is it reliable enough. So that is the valuation method selection criteria. Then we have the cost approach, right? What is the cost approach? Let's see the point. So I told you earlier, in the cost approach, it is based on the cost to rebuild or replace the asset. It is already I told you it is for asset intensive businesses, right? So suppose I want to rebuild the asset or replace the asset, how much it would cost me, right? Suppose I have a huge building, right? I want to rebuild it, I want to replace it, right? So how much would it cost me? That is called the cost approach. This is how the valuation is done. It is perfect for valuing the tangible asset, right, where rebuilding is a realistic option. So cost approach is there, it is helpful. Then we have primary methods. There are some primary methods of valuation also. Let me give you a name. I will discuss in detail about this. So the first is called adjusted book value approach, stock and debt approach. We will cover all these things. Direct comparison approach and discounted cash flow approach. These are the four primary method used. And methodology, sometimes a single method is enough, other time multiple methods are needed to ensure accuracy, especially when data is limited or insufficient. Remember, value reconciliation is all about thoughtful comparison, not simple averaging, right? So that is called value reconciliation. It's all about thoughtful comparison, not simple averaging. So basically this is the a complete overview of the valuation method. So choosing the right valuation approach is not just a step, it is a strategy toward better business decision. Now friends, have a look at this particular flow chart. Very important. It talks about the asset valuation methodology. So friends, asset valuation is a crucial step in understanding the true worth of a business. Let's walk through how different types of assets are evaluated. If you go through the book, you will see multiple lines, paragraph, right? You have to identify yourself what is important, what is not important, and what we do in our crash course, that we filter out the important content for you in the most efficient format, easy to understand, easy to remember. At the last moment before the examination, if you go through such PDF, you will be able to easily recall in the examination all the fact, because mind map work in the same way. Once you hit your mind, you will never forget it. So we have prepared such kind of material for each and every subject. If you are really interested in it, you can enroll in our crash course program. In crash course program, we ensure we provide you such kind of content, right? We are not covering 100% syllabus, rather we are just covering only those part from where questions are being repeatedly asked. Now first of all, let's look at the cash. So cash, the valuation is since there is no change in value, right? Reason is that cash is already at face value, there is nothing to adjust or estimate. Then receivables. So receivable is valuation start with the face value, which means the amount owed, and then adjust for the default risk, meaning you lower the value if there is a chance that some customer may not pay, right? So receivable means what, that suppose you are providing goods or services, some customer takes goods from you and they said that they will pay you later, right? That is called receivable. So first of all, valuation, you start with the face value, means the amount that is owed or the amount the customer has owed to you, right? And if suppose some default happens, somebody don't pay, then you have to reduce that amount. You have to adjust for the default risk. That means you lower the value, right? You should lower the value. Then we have the stocks, which is very important. A stock means inventory. A stock here means inventory. So a stock is valued differently based on their production stage. There are different production stage of stock or inventory. The first is called raw material. So it is done at the last acquisition cost, means what it costs to purchase them. That is how the valuation, asset valuation of the stock in the raw material is done. Then we have WIP, or work in progress. So it is evaluated either cost or selling price depending on the reliability of information. And then we have finished good. It is evaluated at selling price minus cost to complete and sell them, right? So three kinds of things we have just discussed: raw material valuation done at the last acquisition cost, work in progress cost or selling price, finished goods selling price minus cost price. Other current asset, so it is recorded at the book value, means the value listed in the accounting book. Tangible fixed asset, if it is land, so it is valued at the market value, the price it would fetch if sold today. If it is building, it is valued on the replacement cost minus depreciation, means the cost to replace the building today less any loss in value over the time. If it is machinery, then we have to add the market price plus cost associated with making it usable or sellable, right? So these are the tangible fixed asset. What about intangible fixed asset, like patent, trademark, goodwill? So they require unique valuation method, like book value, market value, utility to the business, or remaining useful life. There is a separate chapter for valuation of the intangible fixed asset. And finally we have non-operating asset, means those assets which are not used in daily operation, like suppose surplus land is there or unused building is there. So they are valued at the market value, means what they could sell for currently, right? Like securities, surplus land, disused structure, etc. So basically each type of asset has a tailored method for valuation depending on its nature, whether it is liquid cash, evolving inventory, valuable property, or even intangible intellectual property. Correctly valuing asset ensure accurate financial reporting, better investment decision, and fair business evaluation. Now friends, have a look at the first approach. I told you stock and debt approach, very important. Every aspect which we are going to clear here. So when valuing a company, one trusted method is the stock and debt approach. If you look at the definition, so it is simple. Just add the market value of equity and the market value of the debt. That is your total company value. That's so simple. Market value of equity plus market value of debt. That's it. Now assumptions. What are the assumptions that it made? Very important assumptions. See, this method work on EMH. What is EMH? Efficient market hypothesis, which says that market price already reflect a company true worth. That is called efficient market hypothesis. That it says that market price already reflect a company true worth. For example, let's take a Seashore Limited. As on 31st March 2022, the data is given that equity is 15 lakh share and price per equity is 50 rupees. So it amounts to 7.5 crore. Similarly, debt market value is 14.8 crore. So the total firm value will be 22.3 crore. That is what it says, which says that market price already reflect a company true worth. So this is the market price. It reflects the company true worth. Right, that is the example. Now there is some controversy regarding it. What is the controversy? But there is a catch. Should we use current market price or an average price? Right. So EMH suggests current market price is the best. What is EMH? EMH, I told you the formula of EMH, efficient market hypothesis. So EMH says that use current price, right? But because averaging can reduce valuation accuracy, because if you multiple average, then it will reduce the accuracy, right? Valuation accuracy. So what is the key implication, key takeaway? That that if the market is efficient, the stock and depth approach is reliable. Always use lean data prices, not average price, for the most accurate result. So the stock and depth approach shows us the power of market signal, but it needs a keen understanding of the market efficiency to get it right, because everything depends on the market. What is the market value of equity? What is the market value of debt? Then only you will add them now, right? So this was all about the what we have just discussed is the market, is the stock and depth approach. The second approach we have is called DCM, direct comparison approach. So when it comes to determining the true value, direct comparison is one of the most straightforward method, right? What is the principle? It works on the principle of substitution. Simple idea, substitution, that no buyer will pay more than what it costs to buy a similar competitive property, right? So no buyer pay more than cost of a similar competitive property. Very, very important. This is a principle. Now if you look at the steps involved, first determine the highest and best use of the asset, that is called HBU. HBU means highest and best use of the asset. Next, identify the comparable sale, means similar transaction. You find the similar transaction and then you adjust the sale value based on the difference. So 3-step process I told you. HBU means highest and best use of the asset. Then identify the comparable sale, means find similar transaction, and finally adjust the sale value based on the difference, right? So these are the 3 steps: HBU, comparable sale, adjust the sale value. Now if you look at the methods, so here we have the methods. The focus is to find similar business or asset and use current market price for accurate reflection. So that is the focus. The focus is to find similar business or asset and use current market price for an accurate reflection. If you look at the comparables, so the trick is that minimal adjustment, right? The closer the comparable, the better the valuation and higher the accuracy, right? The closer the comparable, the better the valuation, the higher the accuracy. And if you talk about the adjustment, so what is the adjustment? First, perform a time adjustment, means aligning old sale to the current value. Then apply any other necessary adjustment, but always adjust on a per unit basis, right? So in this valuation, the direct comparison approach reminds us that real world comparison, when done carefully, it creates the clearest path to the true value. That is why I told you HBU is done. HBU means highest and best use. We identify comparable sale, find similar transaction, and finally adjust sales value. Adjustment is done, sometimes time adjustment is done, right? So means aligning old sale to the current value and apply any other necessary adjustment. So these are the steps, complete steps regarding the direct comparison approach. And in our theory video, I have provided a numerical problem also based on a step-by-step explanation of how to go about solving a problem based on direct comparison approach. It is not feasible to describe the entire process here, because the entire calculation will itself take 20 to 30 minutes. So I request you to please go through the theory videos. Now friends, let's look at the financial performance overview, some very important metrics which are very important role. So let's break down the terms one by one. First of all, the invested capital. Imagine a business need money to buy machine, building or other resources. Invested capital is the total money that come from shareholder, that means owner, and the lender, which means bank or investor, to buy all kinds of asset, whether they are using daily or just sitting there, right? So that is the point. The invested capital means whatever fund that has been accumulated from the shareholder or the lender like bank to buy all kind of asset. This is called the invested capital. Then we have operating invested capital. This focus only on the part of the business that are used day to day, daily run operation. Means it focus on the part of the business that are used daily. It includes machine, factory, working cash, basically everything that help the company make and sell product. That is called operating invested capital. So the formula is quite simple, that operating asset plus operating working capital. Now what is this operating working capital? This is short-term money movement. That is why working capital. It is the money tied up in everyday operation, like buying inventory, stock, or waiting for customer to pay, receivable, or paying supplier. That is called liability, right? So the formula is operating asset, which means cash in. You can see the formula, operating working capital asset, which means cash in products, means bill minus bill we owe, that is cash out. So cash in minus cash out. That is very, very simple formula. So non-interest bearing current liability means these are the bill which we owe. That is called cash out, which we have to pay. And operating asset means cash in, means some product. I told you some money is tied up in everyday operation. That is cash in, right? And cash out. This tells us how much money the business need daily to run smoothly, right? To run smoothly, how much money the business need. That is called operating working capital. Formula is quite simple, operating working asset, right, and minus the bill, non-current interest bearing current liability. Then we have NOPLAT, net operating profit less adjusted tax. Fancy name but simple idea. It is the actual profit the company made from running in business after paying the normal tax. So after doing business and paying tax, how much real money is left? That is called NOPLAT, right? So after doing business, after paying tax, how much real money is left? So that is called NOPLAT. The formula is quite simple, EBIT, earning before interest and tax, minus tax on EBIT. That is called NOPLAT, net operating profit less adjusted tax. What is EBIT? EBIT, earning before interest and tax. So this is the interest, this is the income the business made before paying off loan, that is the interest, before paying out government tax. So it has not paid interest, it has not paid government tax. The total income it has made, the company has made, is called EBIT. It shows how much the core business earned before any extra cost comes into pay. For example, if a bakery make $10,000 before paying tax and bank loan, that is their EBIT. And what is the tax on EBIT? These are theoretical tax a business would pay if they had no loan, no extra cash lying around, no weird gain or loss. It gives a pure view of tax impact on operating profit. So in short, if we summarize these 5 kinds of parameter which we have just gone through, let me summarize it. Invested capital, get the machine running. Operating invested capital, right, it powers daily work. Of working capital keeps cash flowing. EBIT, so earning before outside cost. NOPLAT, so real business profit after tax. And tax on EBIT is what the taxman theoretically takes. Now one more important parameter is ROIC, right? So what is ROIC? So at the heart, ROIC stands for return on invested capital. The formula is NOPLAT upon operating invested capital. NOPLAT I told you, that is EBIT minus tax on EBIT, and operating invested capital already I told you here, right? This the formula regarding it, that is operating invested capital here, operating asset plus operating working capital, right? So just write in the denominator, you will get ROIC. So it measures how much profit a company generate for every dollar invested in its operation, right? So that is why in the denominator we have operating investment, means every dollar we have invested in the operation, how much profit the company generate, that is called ROIC. Now while calculating ROIC, consistency is the key. Use either the beginning or the ending or the average value for your investment, but whatever you choose, stay consistent between the numerator and the denominator. Then only your result will be consistent, accurate and reliable. Now then we have the net investment. It is the amount a company actually spend on new asset after accounting for wear and tear. So how much amount the company invest on new asset is called the net investment. It is equal to gross investment minus depreciation. Just like net salary is equal to gross salary minus deduction. Similarly, what is gross investment? It is the total money spent on both current and long-term asset. Everything from buying machine to upgrading technology. And what is depreciation? Over the time asset lose value. Depreciation is the non-cash accounting method that reduce the book value of asset every year, reflecting this gradual loss. So there is alternate formula, that net fixed asset plus net current asset at the end of year minus net fixed asset plus net current asset at the start of the year. This gives a full year picture of how much net investment was made. We are discussing other non-discounted cash flow valuation model. The first of its kind we have is called relative valuation model. So let's dive into relative valuation model. See, when direct valuation is difficult, relative valuation become our go-to tool. It works by comparing the company with similar company in the market. If you look at the application of the relative valuation method, as you can see, so we use market comparable to determine pricing, especially when direct valuation method are not practical. So then we use market comparable to determine the pricing. If we talk about how it is related to DCF, see, DCF means discounted cash flow. Relative valuation complements DCF. This is very important thing. This relative valuation model complement DCF, right? While DCF focus on absolute cash flow, relative valuation focus on market driven metrics, right? So in the case of DCF, it focus on absolute cash flow. Cash flow plays a super important role, while in this case relative valuation, it depends on market driven metrics, right? So this is called relation to DCF. Then we have DCF valuation. See, here we focus on fundamentals like cash flow, growth, risk to find an absolute value, and relative valuation brings in market realism. So what we focus in DCF valuation? Cash flow, growth, risk, right, to find absolute value. Now there is something called human behavior factor. So as Dan Ariely say, human judge value relatively, not absolutely. Right, this is very important thing. Dan Ariely says that human judge value relatively, not absolutely. What does it mean? That we tend to compare prices rather than evaluate them independently. Interesting, right? What we do, we tend to compare price rather than evaluating them independently. So what is the core idea? The core idea is that if two assets are similar, they should have similar price. Simple common sense mixed with economic logic. One example is given for easy understanding. Imagine 2 acres of land sold at rupees 10 lakh total, right? So obviously what is the price per acre? It is nothing but 5 lakh rupees per acre, isn't it? Because 2 acre is sold at 10 lakh, so per acre cost is 5 lakh. So what will be the cost of 5 acre? It will be simple, 5 into 5 lakh is equal to 25 lakh. So this is how this relative valuation model works. So just let me go through remind you the important points. Application, use market comparable for pricing. Relation to DCF, because I told you it complement DCF, and it cash flow DCF valuation, I told you that here we focus on fundamentals. In the case of DCF valuation, we focus on fundamentals like cash flow, growth, risk to find absolute value. But relative valuation bring in market realism, right? And human behavior factor is also always there. Dan Ariely say human judge value relatively, not absolutely, right? Like we tend to compare price rather than evaluate them independently. So core idea I told you, if two assets are similar, right? If two assets are similar, they should have similar price. Simple common sense, right? Now, so that is all about relative valuation model. Now there are very important multiple which we will explore one by one now. The first multiple is PYE multiple. So in this particular slide, every aspect related to PYE has been taken care of. So let's get started. So first of all, let's explore the PYE multiple. So the PYE concept was introduced by Graham and Dodd in 1934, right, laying the foundation for value investing. So definition is quite simple. You look at the definition. Definition is simple. It says that PYE is equal to, in the numerator we write the price, in the denominator we write the earning. So price of what? Market price per share, and earning of what? Earning per share. So per share on both numerator as well as denominator. So market price per share divided by earning per share, this is called PYE, right? Again I am repeating, PYE means P means market price per share, in E means to earning per share. So EPS is based on past earning, last 12-month earning, right? And EPS or expected future EPS, which means current or next year, right? So it is based on either the past earning, last 12-month EPS, or expected future EPS. So this is the basis of calculating the EPS. Either you take the past earning, or you take the last 12-month EPS, or you take the expected future EPS. And the most common terminology is P node by E1. This is called P node, P0 or P node, whatever you call it, upon E1, which means current price divided by expected earning next year. So what is the meaning of P node by E1? P node is the current price and E1 is the expected EPS or expected earning next year. This is the most commonly used, right? Now fundamental determinant, very important. So this is the bit of math. Just remember this formula, because question are asked to calculate P node by E1. Formula is 1 minus B divided by R minus ROE times B. So what is 1 minus B? See, 1 minus B is called dividend payout ratio. 1 minus B is called dividend payout ratio. And what is B? B is called retention ratio, right? So B is called retention ratio or plowback ratio, and R is called cost of equity, and ROE is called return on equity. It's like climbing the ladder to success, and the formula clearly show how to value a company stock, right? Obviously, basically by applying the formula, we are valuing the company stock, right? So remember the formula, 1 minus B upon small r minus ROE multiplied by B. So B on both numerator and denominator, right? And in the numerator just 1 minus B, in the denominator R minus ROE times B, and every aspect should be taken care of. Now let's make it easier with an example. One example is given, like let's say VNS company has PYE of 30 or P node by E1 of 30, right? ROE is 20%, cost of equity or small r is 15%. So dividend payout they have given 0.7. So obviously retention ratio will be 0.3 dividend payout they have given. So retention ratio, retention B, small b will be 0.7, right? So if you find P node upon E1, so just apply the formula. So in the numerator just write the dividend payout ratio, right, which is 0.3. In the denominator just write small r, which is what is small r, 0.15, and multiply by minus ROE times B. ROE is how much? ROE is return on equity. Return on equity is 0.20 multiplied by 0.7. So after the calculation, right, so you will get 30. P node upon E1 30. So just you have to remember the formula, 1 minus B upon small r minus ROE times B, you will get the answer. So I hope this particular table explain every aspect of PYE ratio. What is origin, what is definition, what is fundamental determinant, and how. Now let's switch our attention to the next model that we have, is called PYV model. So the formula is P means price and B means book value. So market price per share upon book value per share. Formula is quite simple, right? And let's first look at the definition. So this is one of the classic valuation tool. So PYV is simply market price per share divided by the book value per share. Here book value means the shareholder fund, meaning the company actual net worth shown on the balance sheet. That is called the book value, means shareholder fund, right? Means what is actually shown on the balance sheet. So here you can see the formula, right, in this particular slide. So book value shareholder fund minus preference capital divided by equity share, right? So PYE income statement, PYV balance sheet. Now fundamental determinant. So PYV is influenced by some key financial metric. What are the key financial metric which influence, like ROE, return on equity, retention ratio, cost of equity, growth rate, and the formula is ROE multiplied by 1 minus B divided by R minus G, right? So this is how you calculate the P node by B node, which is the fundamental determinant. So ROE multiplied by 1 minus b upon r minus g. B is the retention ratio, or 1 minus b is the dividend payout ratio, and ROE is the return on equity, R is the cost of equity, G is the growth rate. So one example is given. Suppose ROE is 25%, cost of equity is 18%, dividend payout is 0.5, right? So what will be PYV? Just apply the formula. ROE is 25% multiplied by 1 minus b, or just write multiply by 0.5 divided by r minus g, 0.18 minus 0.15. So this will give you approximately 4.17, showing that premium investor are willing to pay over the book value, right? So this is called, P note by B note value. Now what is the reason of using this P by B? So because it is a stable even when earning are negative. You can see even when earning are negative, book value will be stable. It remain consistent when earning are volatile, right? So when EPS is volatile, the book value remain consistent. Also PYB has a strong correlation with long-term return. So this is another reason for using this PYB multiple. So 3 reasons I told you. First reason is, it is stable even when earning are negative. It remains consistent when earning are volatile. Plus PYB has a strong correlation with long-term return. What are some limitations to watch out for in this particular case? Yes, so of course there are some limitations also. First of all, it ignores the intangible asset. Yes, there are some intangible assets also, like brand, human capital, so it does not take into account. Also inflation, technology change, widen book versus market value gap. So that is all about PYB multiple. Now we have PYS multiple. So that is called price to sale. So here you can see the PYS multiple, right? What is the definition of PYS multiple? P means market price per share and divided by the sales per share, right? Or simply market cap divided by the annual sale, right? It tells us how much the market is willing to pay for every rupees of the sale the company generate. How much market is willing to pay for every rupees of sale that the company generate. That is called PYS. Now why use PYS over PYE? Why do we use it? Sometimes earning can be volatile, sometimes negative or manipulated, right? Sales on the other hand are usually more stable and transparent, making the PYS ratio more reliable indicator. Because earning can be volatile, it can be negative, it can be manipulated, but sales cannot be, right? So sales are usually more stable and transparent. So that is why this is the most reliable indicator. And one more thing is that low PYS, it means better. Low PYS, it means better. Why? Because of better opportunity. A PYS of ratio of less than 1 often signal potential undervaluation, right? It signals the undervaluation, right? For example, a company with PYS of 0.5, right, could be a hidden gem, but always compare it with industry average and the company own history, right? So compare PYS with industry average and plus company own history. Because PYS less than 1, it means undervaluation. A company with PYS of 0.5 could be a hidden gem, but always compare it with the industry average and the company own history. If you look at the basic PYS determinant, the formula is simple: NPM, net profit margin, multiplied by 1 plus G. G is the growth rate, multiplied by 1 minus B, right? 1 minus B is the dividend payout ratio, or B is the retention ratio, and divided by R minus G. So basically this is the simple thing, right? 1 minus B divided by R minus G, the same thing we have done in the previous case also, PYB also, but here NPM and 1 plus G, 2 things extra, right? So NPM means net profit margin, G is the growth rate, B is the retention ratio, right? And small r is the required return on equity. So this is called basic PYS determinant. Now what are the advantages of using PYS? Very important. It is less prone to manipulation compared to EPS or book value. First point, less prone to manipulation than EPS or book value. Then sales number remain positive and stable. Sales usually positive. Sales remain stable even when earning fluctuate. And Last point, sales are less impacted by the debt level compared to the earning. I told you na, this is the most reliable ratio, PYS. It is less prone to manipulation. Sales usually positive even if EPS book value negative, and sales is more stable versus EPS. So the leverage is having the less impact. So debt level is having less impact on sale as compared to the earning. So the PYS multiple is a simple yet powerful tool for identifying a stable, valuable company, especially when earning are not telling the full story. Sometimes earning does not tell you the full story. And after PYS multiple ratio, the next multiple is we have PEG and modified multiple, right? So using PEG and modified multiple, it let you see beyond just surface number, helping you spot the true value and avoid hidden risk. So first of all, let's understand PEG. So start with the equity multiple. Here you will see three kinds of multiples are there. I think this thing we have already seen. Equity multiple we have already seen. 3 equity multiple. Just revise it. Price by earning. Formula is 1 minus B upon R minus G. Right. Price by book value. Price to book value. So 1 minus B R minus G already there. Just multiplied by ROE, and which is return on equity. And the third is price by price to sales. So here we have NPM. Right. So NPM multiplied by 1 plus G multiplied by 1 minus. So one thing is common. 1 minus B upon R minus G is common in all these three equity multiples. But you know what happened? The real world investing demand more precision, and that is where modification comes into picture. So that is called modified multiples. So we adjust traditional multiple to factor in growth, margin and return. So I think you know what is the meaning of B. B means retention ratio. R is the small r is the required return. G is the growth rate. NPM is the net profit margin. Right. Now friends, PEG. PEG means what? PEG ratio. So PEG means P by E divided by expected EPS growth. So this is the formula written in front of you. P by E in the numerator and expected EPS growth in the denominator. So two things can be possible, either PEG less than 1 or PEG greater than 1. If PEG less than 1, it means stock is undervalued, so it means a potential bargain case. And if PEG is greater than 1, it means stock may be overvalued, it means here caution is required. So that is called PEG ratio. So P upon earning, expected growth, that is called a PEG ratio. And other smart ratios are also there, like value ratio, which is P by V divided by ROE, or PSM ratio, which is P by S divided by NPM. So very easy to understand modified multiple how it come, right? So P by V upon ROE, P by S upon NPM, P by E upon expected EPS growth rate. I hope it makes sense to you. So that is all about P by G, PEG multiple. So less than 1 undervaluation, more than 1 overvaluation, right? So here caution is required. Now friends, let's look at some other multiple like EV to EVI TDA multiple, right? EV to EVI TDA multiple. Let's talk about it. What is this EV to EVI TDA multiple? So first of all, the question is what is enterprise value, right? So what is the meaning of enterprise value? Enterprise value is the sum of equity value plus interest bearing debt, right, minus cash. Cash is subtracted. So this is called enterprise value. Equity value plus interest bearing debt minus cash. Why we subtract the cash? We subtract the cash to prevent overstating a company true value from the non-core interest income, right? So that's why we subtract cash to prevent overstating a company true value from the non-core interest income, because cash is a kind of non-core interest income. If we understand the basic determinant, so EV upon EVI TDA depends on some fundamental principle like ROIC, small g, DA, T, and WACC, which is called weighted average cost of capital. These are the basic determinant. ROIC, return on invested capital, small g, growth rate. DA means, what is the meaning of DA? DA means, depreciation and amortization. Small t is the tax rate, and WACC is the weighted average cost of capital. So this is how we understand the basic determinant using the enterprise value calculation. Now one more thing. So I hope this formula you must remember. What is ROIC, what is small g, what is DA, right? Now a lower multiple might hint the company is undervalued, but always check this factor first. Now if you compare EBITDA versus FCFF, so FCFF is free cash flow to the firm. So EBITDA is close to FCFF, but EBITDA is more stable and easier to compare across company, especially mature one. So suppose some mature companies are there, right? So in that case, EBITDA is more stable and fixed income. So it is more stable, it is easier to compare across. So that is the relationship between EBITDA and FCFF, right? Close to FCFF, EBITDA is more stable and easier to compare across different company. So one simple formula you must remember: EBITDA is equal to EBIT, earning before interest and tax, plus depreciation plan amortization. So this formula will also help you, right? And what about the EBITDA popularity? Very much popularity. It is more stable than FCFF. It is ideal for matching firm with existing asset. And EBITDA is just like pre-tax cash flow, more volatile, affected by the capex and NWC change. Now let's look at the next point. That is what we have: EV upon EBIT. So the formula for EV upon EBIT, in the numerator we write the enterprise value, and in the denominator we divide by the EBIT. Enterprise value, how to calculate, I already told you in the previous slide. Let me again take back to you there, right? So here we find the equity value plus interest bearing debt minus cash. That is called enterprise value, right? And same enterprise value is to be put in the numerator, and EBIT is to be put in the denominator, right? And if we do the same calculation after adjusting for tax, which is equal to EV upon EBIT divided by 1 minus tax. So after adjusting for tax, just multiplied by 1 minus tax in the left hand side, which will be equal to EV enterprise value divided by NOPAT. That is called net operating profit after tax, right? So this is the change in the formula. Now what are the key driver behind the scene? So EV upon EBIT multiple is influenced by what are the factors? The first factor is the tax rate. So just 1 minus tax rate. So these are the basic determinant, as you can see. So first is the tax rate, is denoted by small t. WACC, weighted average cost of capital. G means growth rate, and R, reinvestment rate, means how much of the earning are put back into the business. And the formula is 1 minus t multiplied by 1 minus reinvestment rate divided by WACC minus G. So this is the funda for computing EV upon EBIT, right? So again I am repeating: 1 minus reinvestment rate Now what about EV upon FCFF multiple? What is FCFF? Free cash flow to the firm. So the formula is quite simple. So what you do, which is 1 divided by WACC minus G. So in the denominator just write WACC minus G and take it reciprocal. This will give you EV upon FCFF, enterprise value upon free cash flow to the firm, right? So WACC weighted average cost of capital, and G that is called growth rate, right? Okay, now we have something called reinvestment rate. It was portion of the earning reinvested back into the company, that's called reinvestment rate. Now the next kind of enterprise value we have is called EV upon BV multiple. So enterprise value multiple, like EV upon BV, EV upon sales, give investor a powerful lens to evaluate companies beyond just profit, focusing instead of how real value creation. Now first of all, let's talk about EV upon BV. So enterprise value divided by book value of the asset. This help you see how much how much investor are willing to pay compared to the book value of the company asset, right? That is called EV upon BV multiple. Again I am repeating it. This help you understand how much the investor are willing to pay compared to books of debt. Now the question is, what are the basic determinant of this EV upon BV? What drive this EV upon EV? So ROIC minus share. So enterprise value, EV upon BV, enterprise value divided by the book value of the asset, that is called EV upon BV. And this help you see how much investor are willing to pay compared to the book value of the company asset. What are the factors which affect this book value EV upon BV? So it is nothing but ROIC, that is called return on invested capital, small g, which is growth rate, and WACC, which is weighted average cost of capital. And what is the formula? So 1 upon WACC minus g is as common, but in the numerator we have ROIC minus g also. ROIC minus G divided by WACC minus G, because it captures both profitability in the form of ROIC and growth potential in one simple ratio. That is the importance of it. Then we have EV upon sales multiple. EV means enterprise value, sales you know it very well, right? This tells you how much value the market places on every rupee or every dollar of the company's sale. So for every rupees or every dollar of the company sale, how much value the market place on every rupee, right? That is called enterprise value upon sales multiple. So what is the formula? After tax operating margin multiplied by 1 plus G multiplied by 1 minus reinvestment rate divided by WACC minus G, which is common in everything. After tax operating margin multiplied by 1 plus G multiplied by 1 minus reinvestment rate divided by WACC minus G. Now what about the reinvestment rate? So again, small g is the growth rate, WACC is the weighted average cost of capital, and reinvestment rate is the portion of the earning invested. So this formula you must remember for this EV upon sales multiple. So in this particular slide we have covered EV upon BV, EV upon sale, right? Two kinds of method we have covered, right? Now so that is all you need to learn from this particular chapter. We have learned various kinds of multiple. If you cover this much, more than enough, because most of the time question has been repeated from this only, right? So you must know the definition, you must know the formula, and you do one, two, three calculation based on them. And hi friends, welcome to the crash course unit number 17. Chapter name is merger, acquisition and restructuring. So friends, let's start with this chapter with our first topic, which is a special reorganization procedure with perspective to India. So let's explore the landscape of special reorganization procedures in India designed to breathe new life into unviable firms. So in this particular umbrella shaped diagram, every aspect will be made clear regarding this special reorganization procedure. So at the center lie a strong regulatory framework upheld by vital legislation like as you can see FEMA 1999, right? FEMA 1999, as you can see, regulatory framework FEMA 1999, the Income Tax of India 1961, right? Industrial Development and Regulation Act of 1951, Competition Act 2002, and SEBI Regulation Act 1992. So these acts together ensure financial discipline, industrial regulation, market fairness, and investor protection. So these acts, so all some acts name I have provided you, right? These are super act. Now friends, moving on to the reconstruction of the SIC unit. The first topic, as you can see, reconstruction of the SIC unit. Right, so it is governed by the SIC Industrial Companies Act of 1985. Right, it is governed. Last time this question was asked, that act name was asked basically. So this reconstruction of the SIC unit is governed by the SIC Industrial Companies Act of 1985. This step help company that are financially ailing but operationally recoverable. So it helps those company which are financially ailing but are operationally recoverable. That is called reconstruction of SIC unit. Right, then comes amalgamation. Right, then comes what called amalgamation, as you can see on the right hand side. So amalgamation means what? This is when two or more firms merge to form a new entity. Shareholder of the original company gains significant stake in the resulting business, paving the way for a strategic consolidation. Right, and one more thing is reconstruction reorganization scheme of arrangement, which means what? Right, single firm alteration of owner or creditor or right. And then we have revival of unviable firm. Right, so basically this particular diagram shows the detail about the reorganization procedure. Either you go for amalgamation, either you reconstruct the SIC unit as per this act provision, or you go for reconstruction reorganization scheme of arrangement, revival of unviable firm, and regulatory frameworks are there in action. Some act name I have already provided. So together these measures form a robust umbrella of revival strategy, guiding distressed business toward recovery and sustainable growth. So this is a brief overview. Now have a look at the types of merger. Very important. We are only covering those topics from where question have appeared in the previous examination. Now when we talk about the business growth through integration, merger comes in various strategic form, each with its unique purpose and impact. First we have something called horizontal merger. So horizontal merger is when company in the same industry join force. So here you can see the keyword same industry. Company in the same industry join forces. The goal is to boost market share, reduce competition, and sometimes even create near monopolies. Think of it as two rivals becoming one strong leader. Right, two rivals are becoming one strong leader. You can think of them like that. This is called horizontal merger. Next we have something called vertical merger. Vertical merger, what happen when a company merge with, so some key points you can see what happen in the horizontal merger. Same types of industries are there. Right, they boost market share, reduce competition, and sometimes they even create near monopoly. So these are horizontal merger. What is vertical merger? So when one company merge with one in its supply chain, when one company merge with another company in its supply chain, right, either a supplier or a distributor, this strengthens the buyer seller relationship and improves supply chain efficiency. This is called vertical merger. So one company merge with one in its supply chain. In the same supply chain, if there is another company and two company merge together, they are called vertical merger. Right, so key points you can see: buyer seller relationship improvement and supply chain integration. Then we have something called conglomerate merger, and for 5 key points have been given to quickly understand conglomerate merger. This is the beauty of this particular slide. Right, everything is written in just keywords. So at the time of examination, if you go through this slide, the keyword will be immediately you can easily get the entire picture clear using these keywords. Conglomerate merger, a bold move where completely unrelated business unite. So here you can see unrelated business, no overlap, right, they unite. So the motive here is diversification, resources utilization, and even a strategic debt expansion. That is called conglomerate merger. Means two industry having nothing in common, right, they unite. They are totally unrelated, they unite. That is called conglomerate merger. Right, then we have congeneric merger. See, congeneric merger is what? This involves company with related technology or complementary products. It allows for broader product range, increase market reach, and enhance technical capability. You can see related technology means those company are merging together with related technology or complementary product. So broader product range, increase market reach, and take technical capability enhancement. And finally we have something called reverse merger. So last slide you can see reverse merger. So it is a lesser known but powerful tool. Here a private firm merges into publicly listed one, allowing it to bypass the lengthy IPO process and gain fast public listing. So what happened in the reverse merger? One private firm merges into a publicly listed one, allowing it to bypass the lengthy IPO process. It does not have to go through the lengthy IPO process, initial public offering process, and it helps them gain fast public listing. So each merger type, so see, we have talked about at least I think 4 types of merger, 5 types to be more precise: horizontal, vertical, conglomerate, congeneric, and reverse. Remember, these merger are most frequently asked. Sometimes case studies is being asked regarding the types of merger. So reverse merger, what happened in the case of reverse merger? I told you, a private firm merged into publicly listed one, allowing it to bypass the lengthy IPO process. So each merger type serve a specific business need, whether it is to dominate, diversify, streamline, scale. Together they shape the dynamic world of corporate restructuring. Right, now have a look at this slide. Merger region, very important. This question was asked, what is the reason for merger? Every aspect has been taken care of in just one single slide. In your book it is given in 3 pages, right? And we are just covering only those things that are important from examination point of view. So when two companies come together through a merger, it is not just a business handshake, it is a strategic leap toward amplified growth and efficiency. First of all, we have something called economies of vertical integration. What does it mean? So merger help align the value chain, bringing production and distribution under one roof, leading to significant cost saving. Right, it leads to significant cost saving. So key points, remember, value chain, right? Align the value chain means bringing, so economy of vertical integration means merger help align the value chain, bringing production and distribution under one roof, leading to significant cost saving. Then we have power of complementary resource. So here you can see complementary resource. So basically what it means, that when one company has strength fill another's gap, it foster innovation and ensure a perfect market fit. See, 2 things are there. Complementary resource means what? Suppose one company has strength fill another gaps, right? So it foster innovation and ensure a perfect market fit. That is called complementary resource. Then we have something called synergistic operating economy. What is the meaning of this synergistic operating economy? Let's understand. So synergistic operating economy, try to understand what it means. The concept of synergistic operating economy is key, where the combined entity is more valuable than the sum of its part. That is what is represented by VAB greater than VA plus VB, which means combined value is larger than the individual value. Combined entity is more valuable than the sum of its part. So this synergy comes from shared services and scaled operation, right? Shared services and scaled operation, 2 ways through which this synergistic operating economy comes into picture. Then we have something called taxation benefit. What is the meaning of taxation benefit? You can't ignore the taxation benefit. Merger allow company to offset accumulated loss, reducing the overall tax burden, right? So offset accumulated loss, whatever loss has been accumulated, to offset that, merger allow company to offset the accumulated loss and to reduce the overall tax burden, right? So this is the taxation benefit of merger. Then we have faster growth, right? So merger also bring faster growth, enabling quicker market entry and saving valuable time that would otherwise goes into building from scratch, right? So faster growth, first of all, a quicker market entry and saving valuable time. Obviously it helps to save the valuable time that would otherwise go into building from scratch. Then we have market power and production. On the left hand side you can see. So with market power and production consolidation, company gain a larger market share and higher production capacity. You can see with with market power and production consolidation, company gain a larger market share and high production capacity, positioning themselves as industry's leader. Then we have economy of scale. So what happened through economy of scale? You can see through economy of scale, larger operation means lower per unit cost and improve efficiency, right? So cost reduction and efficiency improvement. Through economy of scale, larger operation means lower per unit cost and improve efficiency, right? Then we have economy of scope. Economies of scope help expand business offering and utilize asset more effectively across a broader base. That is called economies of scope, right? It help expand business offering and utilize asset more effectively across a broader base. Then finally, merger ensure utilization of surplus fund. Idle capital can be reinvested smartly into a strategic area for growth. That is called utilization of surplus fund. That means idle capital can be reinvested smartly into a strategic area for growth. So together, so let me just summarize the region main point. First of all, economies of vertical integration, complementary resource, synergistic operating economy, taxation benefit, market power and production consolidation, faster growth, economies of scale, economies of scope, utilization of surplus fund. So together these regions paint a powerful picture of why merger are not just about expansion, they are about smarter, faster and more strategic evolution. Now friends, so main driver you can just remember like this: synergy, tax benefit, fast growth, market power, scale, scope, vertical integration, complementary, then surplus use, managerial strength. So these are the main driver. Now have a look at the legal procedure of amalgamation. This is very important aspect. Friends, when company decide to merge, the process is not just strategic. Have a look at the legal procedure for amalgamation. First of all, when company decide to merge, the process is not just strategic, it is deeply legal. Let's walk through the step-by-step procedure of amalgamation in India. So basically, step number 1 is review object clause. Start by checking the MOA, that is called Memorandum of Association, to ensure that merger is within the company scope. If it is not, obtain approval from shareholder, the board and the company law board, right? Then we have step number 2, that is a stock exchange intimation. So inform the stock exchange about the proposed amalgamation and issue formal notice. Transparency is key from the beginning. Third we have is board approval. What is board approval? The draft scheme of amalgamation is placed before the board. Once reviewed, the resolution is passed to move forward. Then we have application to NCLT. Next, a formal application is filed with the National Company Law Tribunal. For a foreign company merger, prior approval from RBI is also required. See, application to NCLT, for basic thing is that a formal application is filed with the NCLT. What is NCLT? National Company Law Tribunal. For foreign company merger, prior approval from RBI is also required. Then we have notice to shareholder and creditor. See, once NCLT give the go ahead, a 30-day notice is issued. This includes publishing the notice in both English and regional newspaper, right, on the company website and via SEBI, that is Security and Exchange Board of India, and the stock exchange. Financial and auditor certificate are shared for inspection. So see, after NCLT approval, send 30-day notice, publish in English plus vernacular newspaper plus company website plus SEBI plus stock exchange. So what that SEBI does? Financial and auditor certificate are shared for inspection, right? So and file compliance affidavit with NCLT. Then we have the last step, that is the conduct meeting. See what happened. Finally, meeting are held with shareholder and creditor, right? So meeting are held with shareholder and creditor. And one more thing is that approval must be secured from at least 75% in value, right? However, if 90% consent is obtained via affidavit, the creditor meeting can be skipped. So remember, one more thing is that 75% approval should be there in the meeting, right? And 10% plus shareholder 5% plus creditor can oppose. Notify central government, ROC, IT department, RBI, CB, CCI. 30-day objection windows is there. Skip creditor meeting if 90% plus consent is obtained via affidavit. So this legal framework. So sometimes question being asked that suppose a foreign company want to merge, so whether RBI approval is required or not. So it is required, right? In which case board approval is required, right? So what should be checked? MOA should be checked, AOA should be checked, what should be checked? So review object clause, stock exchange intimation, board approval, application to NCLT, 30 days notice, right? Very very important. And notice to shareholder and creditor, and then meeting is conducted, and 75% approval is required, right, in the meeting. Now then we have the accounting method for business combination, right? Business combination, just we are talking about this merger, amalgamation, takeover, etc. Let's decode how business account for combination, whether through merger, acquisition, or any other strategic control transfer. So at the core of the business combination, an acquirer gain control. Here you can see acquirer gain control, right, through cash, equity, or other mixed consideration. But how do we account for this? That depends on legal and tax consideration, and most importantly the accounting method selected. So there are two main approach. The first is called, so as you can see, acquisition method, and the second is called the pooling of the interest method. So what happened under the acquisition method, and on the left hand side, as you can see, first of all we identify the acquirer. Who is acquirer? Acquirer is the entity gaining control, means who is acquiring, that is called acquirer, gaining control. Next we determine the acquisition date, means when the control is officially transferred, that is called acquisition date. Then the company must recognize either goodwill or bargain purchase gain, right, depending on the deal's nature. So company must recognize either goodwill or a bargain purchase gain depending on the deal's nature. Finally, asset, liabilities, or any other non-controlling interest called NCI, they are recorded at the fair value. So these are the steps. Just now I told you, in the case of acquisition method, identify acquirer, means the entity gaining control, determine the acquisition date. A company must recognize either goodwill or bargain purchase gain depending on the deal's nature. Finally, asset, liability, and any non-controlling interest are recorded at fair value. And on the other hand, we have the second method, that is called pooling of interest method. It is used less frequently now. So the focus shift to recording assets and liability as they stand, right? Then firm aligning accounting policy across both entity. Then what they do, reserves are adjusted but no goodwill is recorded, emphasizing continuity rather than acquisition. So basically these are two methods of accounting, acquisition method. Now friends, have a look at the role of investment banker in merger and acquisition. When it comes to merger and acquisition, investment banker are not just facilitator, they are a strategic enabler. You can think of them as an umbrella shielding both the parties during high stake financial storm. So let's look at what are their functions. First of all, coordination. It is their first task, identifying the right target, connecting potential acquirer and seller, and ensuring a smooth matchmaking process. Second is defensive strategy, right? So advising firm on how to resist hostile takeover and stay in control when under threat. Then we have something called fair value determination. So they also handle fair value determination, ensuring that valuation is transparent and legally sound, reducing the risk of post-deal lawsuit. Then we have financing merger. On the financial front, they manage financial merger, arranging capital for the acquirer and sometimes even defense funding for the target company. And then arbitrage opportunity. So they operate in the complex world of arbitrage operation, leveraging market movement in traditional and merger and acquisition related arbitrage to maximize the deal efficiency. So coordination, defensive strategy, fair value determination, financial merger, and arbitrage opportunity. So together all these roles make investment banker the central force behind successful merger, balancing risk, opportunity, and values for all the stakeholders. Now have a look at the exchange ratio factor in merger and acquisition. So in a merger or acquisition, one of the most critical element is determining the exchange ratio. What is this exchange ratio? The number of share the acquiring company will offer for each share of the target company. See, two company are there. One is the target company, other is the acquiring company. How many number of share the acquiring company will offer for each share of the target company? For one share of the target company, the number of share acquiring company is offering is called the exchange ratio, right? So but what drive this number? So there are some factors which drive this number. Let's look at those factors. The first factor we have is called book value per share. So it is a balance sheet valuation where exchange ratio is aligned with the combined book value of both entities, right? So if we talk about the book value per share, so the formula is quite simple, that a balance sheet based valuation it is there where exchange ratio is aligned with combined book value of both entity. So as per the book value per share, formula is acquired book value divided by target book value, then exchange per share, earning per share. So this focus on profitability. Higher earning per share typically demand a better exchange offer. Then we have market price per share, right? So it is a real time market driven metric reflecting investor sentiment and share performance. And then we have discounted cash flow, that is called DCF method. It estimates future cash flow, giving us a forward looking value. So together these are the factor: book value per share, earning per share, market per share, discounted cash flow. So these factors ensure that exchange ratio is not just fair but strategically sound, maximizing value for both acquirer and target shareholder. That is called exchange ratio factor in merger and acquisition. Now friends, have a look at the next slide. Takeover, control, types and methods. What is the meaning of it? Let's try to understand. When it comes to corporate strategy, takeover are a powerful tool to gain control of a company, right? It is a very powerful tool to gain control of the company, right? Either with the open arm or in some case again the will of the management. Sometimes open arm, right? Or sometimes again the will of the management. Let's break it down. So control can be of two types: either full control where the acquirer take over completely, or second is effective control where the influence is gained without total ownership. So two types of control are there. Full control means the acquirer take over completely, or effective control where the influence is gained without total ownership. Total ownership is not gained but influence is gained only. And there are two types of takeover. The one is called friendly takeover, second is called hostile takeover. In friendly takeover, management is on board. In hostile takeover, management resists the acquisition, right? So we have seen notable Indian example like Indal was acquired by Hindalco, IPCL was acquired by Reliance, right? Then Ranbaxy Daiki Sankyo deal, right? So these are some examples of it. So friendly takeover means management agree, and hostile takeover is management opposes, right? Now friends, how do takeover happen? Methods of it. Have a look at it on the left hand side. First of all, we have open market purchase. So buying share directly from the stock market, often used in hostile bids. Then we have negotiated acquisition. So it happened, what happened in that case, that buying share privately from promoter or large shareholder. So privately from promoter and large shareholder you are buying shares. And third is called preferential allotment. What happened in preferential allotment? When the company itself issue new share to the acquirer. This is typically a friendly move to boost strategy or to raise fund. So whether friendly or whether fires, takeover shape the future of industry one share at a time, right? Now friends, have a look at this anti-takeover defense flowchart. So what are some defense technique of anti-takeover? So when a company senses that it might be taken over, especially in a hostile way, it can use several defense tactics to protect itself, and these are called anti-takeover defense. Again, I'm repeating, whenever a company senses that it might be taken over, especially in a hostile way, it can use several defense tactics to protect itself. These are called anti-takeover defense, and they fall into two main stages: before and after the takeover takeover offer is made. That is called pre-offer. See, pre-offer defense means before the takeover offer is made. That is called before a takeover bid happen. And second is called post-offer defense. Post-offer defense means after a takeover bid is made. So have a look at the pre-offer defense. Pre-offer defense on the first side we have. What is the meaning of pre-offer defense? The first type we have is called a staggered board. What happened in the staggered board? That the company has split the board of director into three groups elected in a different year, This slows down the process of gaining control. This is called a staggered board. Again, I am repeating. Company is split the board of director into 3 group. Board of director is split into 3 group, and this slow down the process of gaining control. Then we have super majority clause. Instead of simple majority, a very high number like 80% of the vote is needed to approve a merger, making it much harder. Now then we have something called poison spill. This is most frequently asked question. See, the company give existing shareholder the right to buy share or bond at a cheaper price, making it costlier for the outsider to get control. So what happened in poison spill? That the company give existing shareholder the right to buy share or the bond at a cheaper price. So obviously it will become costlier for the outsider to gain control. Then poison puts. Poison puts means company issue bond that can be repaid early if there is a takeover attempt, putting financial pressure on the buyer, right? So if suppose takeover happen, what will happen? So such kind of bond can be repaid earlier, right? So if there is a takeover attempt, so it will put financial pressure on the buyer. Then we have dual class share. See, the company create a special class of share with more voting power, helping the original owner stay in control. Then we have golden parachute. So if the top executive was removed after a takeover, they get huge payout. This make the takeover more expensive, right? So if the top executive, right, are removed after a takeover, they get huge payout. This make the takeover more expensive. So these 1, 2, 3, 4, 5 and 6. So these 6 are the pre-offer defense. Why they are called pre-offer defense? Because before a takeover bid happen, these strategies are taken into action. A staggered board, right? Board is split into 3 groups. Super majority clause, poison spill, poison put, dual class share, golden parachute. Now we have post-offer defense. What happened in the post-offer defense? After a takeover bid is made, the first technique that is used called green mail. What is green mail? See, in green mail, the target company buy back its own share from the bidder at a higher price to stop the takeover attempt. Then we have Pac-Man defense. So Pac-Man defense means what? The target company turns the table and try to buy the company that is trying to buying it, right? So the target company turn the table and try to buy the company that is trying to buying it. Litigation means the target company sue the bidder, usually claiming rule violation to slow down or stop the process. Asset restructuring means the company sell its best part, called the crown jewel, or buy poor performing asset to make itself less attractive to the bidder. Or liability restructuring, the company take on new debt or buy back its own share to make the deal harder or costlier for the bidder. So in short, these are the tactics, right? These are act like a shield that a company put up to avoid being forcefully taken over. Some strategy buy time, other may take over more expensive or complicated, and some just fight back, right? So that is all about the anti-defense takeover, and that is all we need to learn from this particular chapter. So all the videos which I provide you, hardly for 20 minutes. If you cover these 20 minutes, I hope you have sufficient knowledge, and after that solve the MCQs, you will have enough knowledge, right, to solve the question confidently in the examination. And if you want to get such kind of content, you can enroll in our crash course program. Description is available, the link of the course is available in the description section. Thank you.